Hey y'all, I'm Roger Herring. I am the Investor's Accountant. I started a little firm about 20 years ago that evolved in what is now Investors Accounting LLC. And welcome to this week's version of Ask Roger. This is where you get to ask me a tax, real estate, or finance related question. You know, a few weeks ago we did a segment on leverage, and that's gotten some pretty good response. There's over 1,000 views here on YouTube with that. But we got some comments, and I thought that I would do a part 2 and address some of these comments. You know, one of them was, well, what about security of a paid off house? Instead of having a mortgage, why don't I pay off my house? Well, first off, this was about an investment property. All right, we were talking about building an investment portfolio. We weren't talking about your primary residence. However, I think you should have a mortgage on your primary residence because it's an excellent hedge against inflation. But that being said, the next comment was, what about all that interest expense that you're going to wind up paying? Well, I thought we would talk about just what happens with that interest expense today and why carrying a mortgage is a pretty good idea if you're building a portfolio. Now, if you are looking for security, you want some rental income, but you want a paid off property and you only want one or two of them, there's nothing wrong with that. I'm talking about an investor that wants to build a portfolio. So, let's review last week. Let's go to the board. So, first off, let me get my handy dandy Sharpie here. Let's review the last segment that we did on this. If you have $100,000 to invest, you can do what we're going to call Plan A. In Plan A, you take all $100,000 and you buy a property. Now, let me go ahead and tell you, these examples are based on a real property owned by a real client. The mortgage rates are actual mortgage rates as of June 15th. Okay, so all of this that we're talking is real. So, this property, it costs you $100,000. And you can collect rents of about $10,000 on this property where it is. You're going to have some holding costs. And those come to about $2,000 a year. So that property is putting $8,000 into your pocket. Well, 8% off of $100,000 a year, that's a heck of a lot better than you're going to do down at the bank. But here was my point. What if instead of putting all $100,000 into one property, we put $20,000 down and then we financed $80,000? We have the same cash flow as above, the $8,000, but now we've got $5,000 in debt service cost, and that is principal and interest. So those are going to cash flow $3,000. But if you're only putting $20,000 down and you have $100,000 to invest, you can do this a total of 5 times. So now you're cash flowing $15,000 a year. That's a 15% return. So that was where we stopped in part 1. Let's talk about the rest of the story, as old Paul Harvey would say. Let's talk about what happens. Plan A has no mortgage. Over 15 years, what's your interest cost? There is no mortgage. No interest whatsoever. But you're only cash flowing $8,000 a year. Over a 15-year time frame, you're going to put $120,000 into your pocket. Now that seems like a good deal, but look here. You're going to have to wait almost 13 years before you can buy a second property. Because if you're investing with cash, you need another $100,000. Well, you can do the math. Between 12 and 13 years, you can buy another one. Then there's Plan B. In Plan B, we are paying interest. Over 15 years, we are going to pay, are you ready for this? Here it comes, $200 $240,000 in interest. But that interest is deductible. And consider this. That cash flow was $15,000 each year times 15 years. That is $225,000 in your pocket. And this 240 has already been taken out of this. This is real cash in your pocket. Guys, in this scenario, you can buy a new property every 16 months. And so that would add another $3,000 worth of cash flow. And that's not even taking into account rent increases. So, I got hit with another question. Roger, what if I did a 15-year mortgage? Well, let's take a look at a 15-year mortgage. We'll call it Plan C. You're going to do this over 15 years. So, that interest cost on a 15-year mortgage is only $160,000. Well, you say, well, Roger, that beats $240,000. Yeah, but here's the problem. The cash flow off of every one of those properties, because of the increased cost of debt service, is only $610 a year. That's pretty weak. Do that over 5 properties, that's what? $3,050 a year. Times 15 years, that's $45,750. So, here's the question. Do you want $45,000? Or do you want $225,000? At the end of the day, gang, it's a cash flow game. So when we're playing this game in building a portfolio, it is totally about cash flow. It's not about how much interest we're paying, because we're buying with other people's money and we're paying the bill with the rents, which is what? Someone else's money. We're hedging against inflation because that mortgage payment always stays the same, whereas rents are going to go up, and guess what? The value of the property is going to appreciate as well. And the bottom line, we're using $100,000 of our money to control $500,000 in residential real estate. That's what it's all about. We're talking about building a portfolio. If you just want 1 or 2 rental properties, this isn't the way to do it. But if you're looking to be serious and get into the rental industry and build a portfolio and build cash flow, leverage is the way to go. Alright, if you guys want to get in, put a comment down here, comment over on Facebook, shoot me an inbox, or email info@investorsaccounting.com. Love to hear what you have to say. Until the next time, Roger out.